Hey, everybody, welcome. Glad that you are here this evening, this afternoon, wherever you are in the US. And we'll get started in a minute. I know we had quite a few registrations for this webinar, so we'll give people a minute or so to log on and get here with us. So my name's Mike Morawski. If you're not familiar with me, I'm a multifamily owner-operator. I am in Southern California, and I'm joined by some great panelists here today. So super excited about that, and still have a number of people logging on. So we'll just kind of give them a chance to get here, and we'll get started. So, okay. All right. I'm going to, I'll just kind of do a brief introduction here and give you an outline of what we're going to do here this afternoon, and then we'll jump in. But glad that you're here, whether you're joining us as a passive investor looking for a place to place capital and be more intentional about placing that capital, or someone who's looking to learn how to raise capital and build meaningful relationships in this space, you're exactly in the right room this afternoon. I know you won't be disappointed, but we're not here to sell you anything today. We're here to bring you some education to help you make better decisions on your investments in the coming months, based on really where we're at in the market cycle. With the market shifting quickly again, now's the time to position your investments for tomorrow for yourself. We're living in a time where traditional paths to build wealth, like stocks, savings, bonds, uh, uh, even single family real estate, are being challenged more and more. Investors are turning toward alternative investments, and specifically multifamily real estate, for one simple reason. And we're going to talk about a couple of different asset classes on the call here this afternoon. Investors want cash flow, they want tax advantages, and they want long-term wealth creation without having to have to deal with tenants, toilets, and trash. But here's the truth. Great deals don't get done without great capital. And great capital doesn't come without trust, relationships, and communication. And that's what today's about. Today, we're going beyond the surface level of just conversation. We're diving into what it really takes, how to build trust with investors, communicate effectively during and after the deal, scaling your capital raising business, and developing the mindset required to operate at a higher level in this space. And to do that, I brought together three experts who are actively doing this at a high level. We're joined tonight by Jennifer Maldonado, Kate Gress, and Jeff Dixon. And we had a fourth guest who was going to be with us, Patrick Grimes, who had a last minute emergency and couldn't be here. So we hope that everything's okay on his end. Each of them, though, bring a unique perspective, from building investor databases and raising millions in capital to structuring deals, nurturing relationships, and scaling their platforms. These aren't just theories. They're actually in the trenches doing deals, working with investors, navigating the same market conditions that we all are facing today. So my encouragement to you is to do this. Lean in, take some notes. If you're driving, you might want to pull over and take those notes. And most importantly, think about how you can apply what you hear today, whether you're deploying capital or you're raising it. Because at the end of the day, the business comes down to one thing: people, relationships, and trust. And if you can master those, you can win in any market. So we're going to jump in and get started. I'm going to ask the panelists to give a brief introduction about themselves and who they are. Kate, why don't we start with you?
Sure. Well, hi, Mike, and thank you for having me on the webinar this evening. I am Kate Gress. I am a real estate investor. I'm also a chiropractor. I've had a chiropractic business for the past 27 years. I've been investing in real estate for the past 24 years. Started with some commercial, single family, smaller multifamily, and became a passive investor in multifamily. And now I'm on the active side of syndications, investing in multifamily.
Great. Thanks. Glad you're here, Kate. Thanks. And then how about you, Jen?
Hi, everyone. Here, Jen. I have been in real estate for over 12 years now. My past life, I was an engineer until I decided that I wanted to own assets, have passive income. And I embarked into a trajectory as a passive and active investor. Since then, I have managed over $150 million in assets from multifamily, hospitality, hotels, extended stay, nodes, non-performing. So I just became obsessed with real estate because I saw how awesome it is. And probably if you're here, then all of you are thinking the same thing. So thank you, Mike, for put awesome people together. And I'm looking forward to provide some value and fun stuff to talk about to everybody here.
Awesome. Thanks for being here, Jen. I appreciate it. I know you're traveling this week and had to make some shifts in your schedule. Appreciate it. And Jeff, how about you?
Yeah, hi, Mike. So I have been in financial services since the mid 80s. Yes, the gray hair probably shows that I'm starting to get up there a little bit. Was in the mortgage industry for 35 years. I am now working for UDirect IRA Services. It's a self-directed IRA company that helps people invest retirement money into assets outside of the stock market, like real estate or passive investments, syndications, and so forth. I've been doing that now for 13 years. I'm vice president of production. So I have pretty good experience in being able to help people understand how they can use retirement funds to invest in projects.
Awesome. Thanks for being here, Jeff. I appreciate it. Okay, so I have I have a bunch of questions, and we'll see what we can get through. We'll probably only go 4 or 5 hours this afternoon. So if people can hang in there with us, nah, just kidding. We'll wrap this up in 50 minutes or so. But hey, Jen, let's start with you. How would you define passive investing in today's real estate market?
Ooh, that's a great question. I mean, I play both sides, Mike. And for me, one of the things that has become very critical for passive investors is trust, the right operators,
Mm.
and proper due diligence. I think it's become a triangle because I think we need to evaluate not only the deal, right? There's a role that we need to play. And yes, we sit and we want that check to come in the mailbox, but we have to do our homework. So passive investment goes beyond just waiting for the check. It goes with understanding the people you're working with, understanding the deal, and understanding the uncertainty in the market today so you can do your due diligence appropriately.
Yeah, awesome. Well spoken. Jeff, how about you? I know that you're dealing with a lot of investors who are deploying funds into, different assets and, how would you explain that and maybe even talk about the environment a little bit today?
Yeah, I mean, to me, a passive investment is one where you're just putting money into it. You don't have any active involvement in what's going on with the project itself. Syndications are an excellent example of that. So, a real estate investor puts together a fund, they attract capital. It could be personal funds, retirement funds. People invest their money into the project, but that's all they're doing. They're just putting the money into it. And then the investor themselves, they find the property, they buy it, they handle all the responsibilities of ownership of the property. And then the investor, they get a profit back from that investment. And I would agree with Jen. I mean, you need to vet these things. It doesn't happen very often, but occasionally, someone makes a bad investment into a project. And that's just unfortunate for a number of reasons. It's not always necessarily fraud. It sometimes is just bad timing or circumstances. But if you deal with people that have good reputations and, they have a track record of being able to show that they have performed well in these investment environments before, I mean, you're got a pretty good shot at making a solid investment with them.
Yeah, and I'm glad that you mentioned that, it's not, it doesn't necessarily mean that the operator was bad. It just means that, the environment got bad on us. And sometimes it happens, right? You get caught in somewhere in that market cycle that you maybe shouldn't have got caught in. Kate, how about you? How would you explain passive investing in today's market?
Well, I agree with Jen and Jeff, just vetting the sponsors, having that trust in the operators, doing your due diligence, all of that. I think a lot of what I see, because I work with a lot of other chiropractors, because that's what I do. I sell busy professionals, and they really want that time freedom, right? So a lot of times it's educating them on passive investing, first of all, what that is and what that looks like. Because I think a lot of people that, if they've never been exposed to passive investing, they think real estate investing is let's go buy a single family home and be a landlord and rent it out. And so it's the education piece. And then I think once they get it, that passive investing means more time freedom for them and freeing up, time and having all the benefits, the cash flow, the building the equity, building the wealth, the tax benefits. Then it starts to open their eyes and it becomes very attractive. But at the same time, I think they also have to be, educate themselves on those deals, on the sponsors, doing their own due diligence.
Yeah, absolutely. I think you're spot on, Kate. Hey, I just want to let everybody know too that the chat is open. If you have any questions, would like to make any comments or just say hello, you can use the chat to do that, and we'll try and get those questions answered as we go along. Jen, somebody is saying hi to you. So, hey, so the next thing, how do you, and Jeff, you brought up syndication. So how would you frame what a syndication is today? We may have a bunch of listeners on this afternoon that don't know what a syndication is. How would you explain that?
Yeah. A syndication is where there's going to be a pooling of money from multiple different investors. So, depending on what the actual investment is, could depend on how many investors the real estate agent is looking to bring on board. But it's effectively you're investing in someone else's business, and you're investing along with a number of other people. So you're going to be there's the the general manager, and then just the various limited partners of these investments, and you're going to be a limited partner of this investment opportunity. And then the general partner is the one who has the control over it, makes all the decisions regarding it. And it's kind of interesting. We get the question from general partners a lot. It's like, hey, can I invest in my own deals with my IRA? And it's like, no, the IRS considers that self-dealing, and they don't allow that. So these are going to be investments into third-party deals, nothing of your own. You can put your personal money in your own deal, but you can't put retirement money in it.
Yeah. Jen, any follow-up on that?
Yes, I mean, I think syndications is an entire world out there, right?
Mm.
There's different ways to syndicate deals. As Jeff, he talked a little bit about the structure. I think it's important to point out that the difference between being a private lender and investing in a syndication. A private lender invests directly into the deal, while you are investing in syndication, you're pretty much investing in a business, buying shares. And I think a lot of people don't understand that difference when they're investing passively in real estate in a syndication deal. And a syndication also, it tends to be one deal or one specific project with multiple deals, but also you can have a fund that it's arranged as a syndication. So in other words, it give you the opportunity to invest in someone else's project passively, where someone else control the deal, and you are pretty much putting the money, and your role is to keep up with the updates and the reports and see how your investment is doing. So
Yeah. Hey, Kate, what's one thing that you wish, and I know that you do, and you came to the syndication world by being a flipper and flipping single family properties. But what's one thing that you had to learn or was a mindset shift for you going into the passive side and investing passively into deals and letting someone else do those operations?
It was just a kind of a mindset shift, like just giving up the control, right? Because the way I was doing real estate, I had control over everything. I oversaw everything. But it was kind of a little bit of a relief, like, okay, you just do this. I'll look at the deal. I'll, educate myself, do my due diligence with that. And that looks good. So good. Here, you take my money and you manage all this and deal with it. I don't have to. So there was part of me that was just kind of relief, let's have someone else handle it. I knew enough about real estate and like I said, educated myself on the deal that, I felt good about it. So it was good in that way. But it was kind of a mindset shift and just giving up control.
Yeah. So
Can I add one other thing to that?
yeah, absolutely.
We talked, a lot of this has been like real estate deals. And while those are certainly great, and there's a lot of them out there, that's not the only type of syndication there are. There's
Right.
mortgage funds where you're investing in deals where they're making loans to people. They're not buying properties. They're actually a lender themselves, and they're pooling together money to start making loans to other people. There's crypto syndications. I saw one recently where somebody put together a stock market syndication where they're going to invest people's money into the stock market on their behalf instead of them, being at a brokerage firm and investing in the stock market. Now, maybe there's a lot of stock market syndications, but that was the first one I'd actually seen. And that was in the last, 6 months or so. So I thought that was kind of interesting. So you just need to find what you're comfortable with.
Right, right. And Jeff, you're right. There is a lot of different opportunity out there. There's gas and oil funds. You can invest in a debt fund, in a rescue fund. So there is different opportunity out there. This isn't just investing in a hotel or investing in self-storage or multifamily. So that was good. I'm glad you brought that up. Um, so Jen, if I was a new investor and you were talking to me about investing in one of your offerings, and I said to you, well, how do I know that you're not going to just take my money and run? How would you encourage me to go and vet you or vet the space to see if it made sense for me as an investor?
Yes. I mean, I love this question because I think a lot of people get excited only about the returns and they forget that you need to cross that line. And the person crossing that line is the one delivering those returns. With that being said, the first thing is you need to look at the person delivering the project. When you are investing, yes, you're looking at the spreadsheets, but spreadsheets don't get funded. People do, which it means is the person that you have to bet the most, evaluate the paperwork, do the background check, find out about that person through referrals, ask about them. The network of investors is really small. People think that no one will know them, but if you talk to a few people already investing in real estate, you're going to find out who they are. So I think one, evaluate the person. Second, I know spreadsheets are sexy, numbers are sexy. I'm an engineer. I love anything about that. But in reality, the spreadsheet is just going to be what they have a theory about something, right? And you're going to challenge that. And you can go and talk to other people, especially if you're new. Talk to other people who invest in these type of projects and ask for feedback, right? It's just give you a lot of questions that maybe you haven't think about. And the third thing is, to your point, Mike, sometimes people think that things cannot go wrong. We have to go with the mindset of one, what I'm comfortable investing with, and I'm willing to bet, right? And do that betting on that kind of project because you have to know the market, macro market, micro market, and what kind of factors impact that type of project. And when you're new, the best, easiest, fastest way is to talk to people who has experience investing in these type of project. Not the person, if you're evaluating a real estate deal, don't ask the stockbroker. They don't know about real estate as to someone who invests in that project, right? And I think those three factors helps a lot, and it's a great start point to do your due diligence.
Yeah, awesome. Well spoken, that's for sure. Jeff, how about you? I have to imagine that you get a lot of people that come to do a directment of investment with you direct and say, "Hey, do you know this sponsor?" Or, "Can you tell me anything?" How do you encourage people to go do that due diligence?
Well, we do get people that not only ask, if we know somebody, if we've had good experiences with them, they ask, can you just make referrals about syndications that, I might give some thought to? And unfortunately, we can't make any referrals along those lines. We're not even legally allowed to. So that's not something that we're able to provide to people. Um, there are resources out there where you can look up, a lot of government resources where you can look up to see if people have done criminal activity with in the past. Our CEO, Karen Hall, one of her favorite stories was about there was someone who opened up an account. They had saved $500,000 working in the military, no less. And when she retired, she wanted to make an unsecured loan to somebody. Karen's like, an unsecured $500,000 loan? So she looked up the guy that she wanted to make the loan to, and he'd already been convicted of fraud before.
Hmm.
So, Karen warned her off and she called the FBI and he actually got arrested again. So she actually was very proud of herself about that. But there's government resources that you can look at. There are places like Bigger Pockets, which is a community of investors, a lot of it real estate investors, and they'll give you their opinions about particular companies or people that they have had experiences with. I don't know that I can give a definitive answer to that because it's not an area that we actually can help our clients with specifically.
Yeah. Kate, I know that are a relatively new passive investor. The first time that you did an investment, how did you vet the sponsor?
I just did a lot of Google searching and, just dug into it. Yeah. And just did a lot of educating on passive investing in general and how that works. And because that was kind of a different world for me. So,
Yeah,
yeah.
I think one good question too that we can all ask of a sponsor is, how do you deal? How have you been through a down cycle, and how did you deal with that down cycle? I think one thing that I see is that operators, when it gets tough, they crawl under a rock, and that's when you really have to shine, and you have to keep a very high awareness of your investors, what's going on, and how things are operating. I think transparency. Once you do take an investment from an investor, transparency is very important. So, Jeff, what kind of transparency does you direct want to see from the sponsor after that investment is made, and over the term of the investment?
We actually don't have any requirements about that. The vetting the investor is 100% the client's responsibility. Um, so, I mean, we don't have anything along those lines that we're requiring the sponsor to actually be providing to us on a go forward basis or on a consistent basis.
That's interesting. And Jen, how about you? What's your transparency like?
Yeah, I mean, for us as a syndicator fund manager, it's very critical, one, to disclose how often investors should expect a report and what kind of report. So every time that I'm talking to passive investors, they will see an example of what we provide. Second, access to financials. And I think that a lot of people don't want to give access to the financials. Of course, depending what type of fund you're doing, some of them are more strict and they cannot disclose until they get audited, but they should be a specific process for the investors to know. Second, constant reports. One of the reasons why a lot of my investors love to work with me is because they're seeing constant progress, not only pictures, but also there is what's coming, what's next, what we complete, what are we struggling with. So there's a communication and a relationship being built. And I think that this is what one of the biggest failures for a lot of syndicators, to continue to communicate with their investors, because it creates a close relationship. If not, then you're just a transaction. Maybe you're acting like a bank more than a syndication. I take it personal like that, right? I want to know that my investors are aware of where the investment is going, whether it's going great or we're having hiccups, because things happen. So, and being that transparent upfront and sharing what we're struggling with, what are we doing great with it, has been a key success factor for our funds and syndication with our existing partners.
Yeah, awesome. Yeah, I think it's really important that you stay in front of any challenging situations as well as when things are going good. And the time is going to come when things are going to start going really well again, and we'll be out of this part of this down cycle that we're in. But I know, like our group, we do a newsletter or a news statement once a month, and then we do a quarterly investor update, and we publish all of our financials in the investor portal and keep records there for investors to go and look at any time. And so I think that investors knowing that, it helps build that trust, that confidence in you. And um, how about investor referrals? So are you open with investor referrals? So Kate, if a passive investor wanted to get referrals of other investors that are invested with you, are you free to give that information to them to help them with their due diligence on your group?
Yeah, absolutely. I've had people ask me before, and I'll give them names and say talk to these people and ask them their experience and how it went for them. And yeah, absolutely. I mean, like you said, transparency is so important. So we're totally transparent with everything. I want our investors to feel good about it, going in and knowing that they did all of their own research, their own due diligence, and they talked to people and they've gotten the referrals and they know what they're getting into.
Awesome. And how about you, Jen?
Oh, I love referrals. I love to give referrals
Yeah.
from my own investors, especially the ones that have been the longest with us. So I started in 2016. So I love to give those resources because it shows who they are, why they still investing with us for a long time, and the good times and the times that we have challenges, how we manage. So people get a real feeling of who we are in character. How do we behave as operator? And not only that, Mike, most of my investors, what I want is to give them an experience, not only on numbers, but I want them to feel confidence to refer to friends and family. And our network of investors has been built like that. In general, we haven't advertised there looking for cold audience because we want to give them that experience. And for us, it's a blessing, it's an honor when they say, Jen, can I bring my friend to this project? And that's the kind of experience I'm looking for. And of course, I use it as a tagline when passive investors come, right? And, some of them know, I'm not saying that we always win, right? We have some tough times during these times. We are finding solutions to some of the projects, but our investors know we're going to do the best we can to really get it through the end line somehow, some way. And then to be able to share that with their family members should be, as a syndicator, should be one of your goals. I don't know. That's the way of thinking for me.
Yeah, I think it's awesome. That's for sure. Hey, Lisa is asking a really great question, and she's saying, what are realistic rates of return on a syndicated real estate investment? Maximum 5-year hold. Jeff, do you want to chime in on that?
I'm sorry, that's not an area I have any ability to offer any insight into. The returns that our clients get on their deals, that's not anything we track. So I don't have anything that I don't have any experience in being able to give you a good answer with that.
Okay, thanks. I appreciate that. How about you, Jen?
Did you repeat the question, Mike? I want to make sure I answer accurately.
Yes. What are realistic rates of returns on syndicated real estate investments with a 5-year hold period?
Is one of those answers, it depends, right? Every project will have a projection. It depends what's in the market. There are projects that we pay 8, 10, 12% every year. There's projects for us that has been successfully paying 30% per year. I'm not saying that that's often. And I have projects that have paid 5%. I think a better question will be, as a passive investor, what is the return or what is my investing philosophy that will make me happy and meet my expectations and goal for every year or to 5 years? Because that way it's coming from you and you can match and figure out with other syndicators, hey, is this return realistic? Right? I think that will be a better question.
Yeah. Hey, I have seen some operators bring deals to the market where they're showing returns on value add multifamily products that are mid to upper 20s. And, I think that from an underwriting perspective, you can manipulate those returns to look any way you want. And I think one question, and this goes back to how do you vet a good operator, is you have to ask them about their underwriting process. When we're underwriting today, I'm looking at a deal where I don't have any first year rent growth. And I want to make sure that my future rent growth is very conservative, because there's a lot of reports out there that say, oh, you're going to be able to get this next year and get this. And if you start underwriting at those objectives, you can be in a bad position. So, here's what I know. Money doubles at a rate of 15% every 5 years. And so if I can help, or 4 years, I'm sorry, if I can help my investors make money or double their investment in that period of time with the asset that we have, I think that that's realistic. Most of our underwriting, and I personally won't bring an offering to the market unless I see, a 15 to 17% IRR with some cash flow. But Jen, I like what you said too about asset classes are going to be different. There's RV parks out there that cash flow 10 to 14% a year. There is data centers out there that are cash flowing at 20% a year. So, multifamily is traditional. It's down the middle of the highway, market rate rent multifamily. It's down the middle of the highway, and those returns tend to stay pretty consistent, right around 15 to 17% a year, seeing maybe a 7 to 8% a year cash on cash return as a preferred return. So that's kind of, yeah, go ahead.
And I have something too, because I love where you're pointing that out. Something to keep in mind for Lisa, who asked that question too. When you're looking at these realistic rate of returns, a lot of people forget that it's not only that cash on cash or that internal rate of returns. When they're looking at an asset type, there might be some cost avoidance from the tax portion too that might increase that rate of return. And I think that I don't want to get into the details because it can get complex. But what I'm saying is, to your point, you have to look at the asset, figure out if these match what you really want with your goal. Maybe it's doubling the money every 4 years. Then they have to determine that. Sometimes you can get cash flow, and sometimes it can be tax avoidance, right, in the legal proper way. So something to keep in mind as they're looking at returns.
Yeah, very good point. And I'm glad you brought that up because even in our underwriting, we're not going to put in there any of those tax benefits, right? Because that again inflates the returns. But investors need to know today that, if you're getting a 15% return or projected return, that with the tax benefits from cost segregation and bonus depreciation, that could bump you to 20%, low 20% per year return. So what it's doing is it's putting more cash in the investor's pocket, helping them build longer term wealth, and then the tax benefits. So those are great things to look at. And the other asset class that you're going to see a higher return in is new construction. So new developments will give you a bigger return. The risk is higher. And then the tax benefits are also higher. So you could almost see returns around 30% on a new development as a passive investor, not having to have to lay brick or concrete. So
And I love this is where also projects or accounts become very valuable when you don't have to pay those capital gains too with your retirement accounts.
yeah. Jeff, why don't you talk about that a little bit too? That's that other side of the tax thing.
Yeah, I mean, that's one of the great things about using retirement funds for investing. Your pre-tax dollars, or you don't pay taxes, personal income taxes on those until you take distributions later in life. And if you happen to have a Roth IRA, which is funded with after-tax dollars, then your profits are growing tax exempt. So it can be a great way to build wealth inside of a retirement plan if you can get into the right kind of projects. Now, it is important to understand that, because this does surprise people, there is a tax that an IRA can be subject to, depending upon the specifics of what they're investing into. There's a tax called unrelated debt financed income tax, or UDFI for short. And this comes into play if you're investing in a deal where there's financing involved. And that could be if you're buying a property and financing the purchase yourselves, or if you're investing in a real estate deal and they're using financing for their purchases. It's not a prohibited issue for your IRA to invest in those types of deals, but it is a taxable issue for your IRA to invest in those types of deals. And, a lot of times people go, wait a minute, IRAs don't pay taxes. And it's like, that's not true. And you can even pay taxes in the stock market. There's ways that you can leverage investments in the stock market. And if you do that, then you're going to incur that tax as well. So this isn't unique to the self-directed world, although I would say it's probably more prevalent just because of the type of investments that are more commonplace in the self-directed arena. And the fact that there may be some tax out on a deal doesn't inherently mean it's become a bad deal. You just need to be able to understand the entire project. If you're in the stock market and you're getting a 5% return, I'm just throwing out a number, and then you say, well, I'm going to invest in this real estate fund and I'm going to get 20%. But, if I run the numbers and I owe tax on part of it, I'm going to end up at 15%. Well, I wanted 20%. Yeah, true. But you're far ahead of the 5% you were getting in the stock market. And you still need to try to figure out how to maximize your retirement investments. So, people hear the word tax and they immediately get skittish, but tax doesn't necessarily mean bad. It just means this is something you need to understand.
Yeah, and Wilson made a comment, paying tax is the game. And I would almost say we're all going to pay taxes. We're all responsible for it, but why should we pay more than what we could pay, right? Because there are a lot of areas where we can pay less taxes. Take a cash investor who does a 1031 exchange, and they get to kick the can down the road, and they can kick it all the way down the road till their heirs take over that asset or take over that taxable event, and then their heirs pay less. So this is how the wealthy have built over time. So, Kate, any comments on any of that?
Regarding the paying taxes in the game.
Taxes are returns on investments and.
Yeah. I think that is one of the great benefits of real estate is the tax benefits. Kind of like you said, with the wealthy, and that's partly how they play the game, um, and then just creating that generational wealth, and there's a lot of benefits there. And I'm not a tax expert, so there's not a whole lot I can say on that, but um, I know anywhere there's a way I can reduce the amount of taxes that I pay legally, I'm all for it.
Yeah, awesome. So, one of the things that I tell investors is I'm really a market driven investor. So the market has to make sense before the deal makes sense. Because you could bring me a really good deal in a bad market, and I wouldn't look at it. Or you could bring me a really weak deal in a great market, and I would definitely take a look at it. So Jen, how do you go about, evaluating markets and seeing, because obviously we all know that we have to check the market box off before we even look at the deal.
100%. Mike, I do have a belief that you can make money in any market at any time.
Hmm.
What it changes is the type of assets and the type of market that you're dealing with. With that being said, you always have to buy right. And what does that mean is you have to look at the market that you are and decide, are you buying for cash flow, appreciation, depreciation, right? And
Yeah.
you have to have a very clear understanding of your investment philosophy. And I think that the biggest mistake a lot of investors do, they go and of course they follow the most famous thing, flipping, considering that that's okay in every market, but in reality is not the most appropriate strategy for them where they are today with their finances. I think that there's a lot to be said about that. So when you ask me, I might put me in a market and I will tell you how to make money on that real estate, on that market. But it might come with different asset types. It might come with a different strategy, meaning like I can do money with multifamily, but maybe it's a buying whole, maybe it's a flip, maybe it's changing the business model of that multifamily where maybe I rent it to the government or I rent it to Section A. And that's the only way that these type of projects will be profitable as per today's market. However, depending on the market too, this is when underwriting becomes very important because on certain markets, as per today, you have to discount properties and buy really well, more than before. And I think that there's a little bit of intelligence that you develop as you learn how to underwrite in every market. So it depends, right? So it's very fun. So I think it's more important for people to say where I am financially today, what type of investment meet that criteria. And that will be more very useful for people. But you tell me and we'll make money anywhere.
Yeah, that's an interesting perspective, and I think to my default, because I've been always so focused on market rate multifamily, I've tended to not look at other asset classes and how other asset classes would perform in a market that might not be conducive for multifamily at the time. So, Kate, how do you decide whether that's a market that makes sense? What do you look for in that market?
So when we're looking for properties, multifamily, we're looking at the markets that are showing a lot of growth, looking for, growth in the population, income growth, what's going on in that market. Is it a growing market? Is it a dying market? That sort of thing. What, industries are there? Is it diverse employment opportunities? How are the neighborhoods? Are they safe neighborhoods, good schools, that sort of thing? Just doing the research that way.
Yeah. And then that's really makes a lot of sense, kind of opens the door to if that market is good or bad. So I'm gonna kind of, as a last question here, I want to ask, what do you think differentiates a strong operator from a weak operator? Because I believe that in every asset class, we have strong operators and weak operators. And I'll give an example of that. So back in 2021, 2022, when the market was just flying and cap rates were compressing and pricing was going up and you had the wind at your back and everybody was a genius. And all those operators that had deals during that time, as soon as the market changed and those deals started to devalue, occupancy dropped, challenges with the deals, those same people have left the industry and they've gone to other asset classes or gotten out of real estate, decided to go back to their day job. What do you think that differentiates a strong operator from a weak operator? Jen, because you were cringing the best, I'm going to let you answer that first.
Um, it's a tough question. To your point, I think Warren Buffett says that you only find out who is swimming naked when the tide goes down. And to your point, I think everyone can underwrite in a specific way. Everyone learn from different gurus. I think that what really will make a difference in how people look at deals, beside the character of a person, Mike, because that's something that you find in the way. It's hard to predict that. But a strong operator will try to foresee and prepare for situations unforeseen. In other words, risk management. And when I'm talking about risk management, one of the things that I'm always looking with flippers and developers, and I'm a developer myself, is if I was going to end with this property and I cannot sell it for the price, can I do something else to maintain and cash flow and preserve the principal of the capital? So that ability to answer that for me is one of those critical factors. I know probably Kate and Jeff will add some other stuff, but I think for me, being a passive investor is taking the active investor hat. If an investor can show me that they have think through these uncertainty and have done the numbers, not solid, but at least have an understanding that plans never go according to your plan. You and I know that, right? They hopefully that's what we're hoping, and we do our best. But if they can foresee those risks and lay out how they can mitigate that risk, that's an operator I want to know more about, right? What is their experience? Have they gone through this? And of course, if I want to find out more, I will ask them about their bad deal. Tell me about your bad deal. How do you manage it? What do you do? And depending how they answer, I am looking for character. If these person have the capacity to think differently when things are not going well, or if this is just a person that, to your point, when things go challenging, they just hide under the rock and let it go. So I don't want to invest on that junkie.
Yeah, very well spoken. Kate, how about you?
I think it just does come down to, all the points that Jen said, but just basically, how is their underwriting? Are they stress testing that underwriting? Are they looking at all the what ifs, all the possible scenarios that can happen in the next however many years? What about, the debt? How are they taking on the debt? Is it fixed rate? Is it, variable rate? So those are some of the factors looking at that, and the operator's experience. Yeah. How have they operated in the past when there's been, not ideal conditions in the market? So just all of those, and are they underwriting with reserves? That's another thing. How much are they putting into reserves when they're doing their underwriting?
Yeah, interesting. Jeff, you want to tackle that at all?
Those were great answers. And to me, it's just what you've been able to show in the past. If you have a consistent return on the investments that you are bringing to the table, if you can show these returns and they're solid returns, I mean, there's always going to be a bad deal in there one way or another. But like Kate and Jen are saying, how do you handle your bad deals? Tell me about them. And if you can't get a solid answer on how they handle a bad deal, they may not have an answer that they've even really thought through at that point.
Yeah. And I'll just kind of finish some of that up by saying, just because there was a operator that had a capital call or distributions paused, or the return on a full cycle deal didn't come in where it was projected, doesn't necessarily make that operator weak. I think what differentiates a weak operator from a strong operator is, did they stay the course or did they quit along the way? Because we're going to go into a market cycle right now, or heading into it if we're not already in it, where you're going to look at a lot of operators. There's going to be a bunch of people come back into the market. I don't care what asset class you're in, but what have they been doing the last 3 years? That's what I want to know. And where have they been and how have they been operating? And there's a handful of people that, are good operators out there today. So, hey, I want to thank you guys for being here today. Let me just check, see if there's any other questions. Doesn't look like it. If anybody else has a question and you want to throw it in the chat, go ahead. Listen, so that people can get a hold of you. If you want to tell people how to do that, Jeff, why don't we start with you? and tell people how they can reach out to you if they have interest in you or you direct. And
Sure. Appreciate that. So you can always email me. My email is pretty simple. It's Jeff, Jeff, at udirectira.com. That's just the letter U, directira.com. You can also call or text my cell number, 949-445-4546. I'm always happy to help people with questions about retirement plans and what might be a good fit for them. So yeah, you can email me, you can call me, you can text me. I'm available with all of those.
awesome. Thanks, Jeff. Thanks again for being here. How about you, Kate?
You can find me at ascendequitygrp.com, our website. And if you want to schedule a call, I'm also on LinkedIn, Dr. Kate Gress. And yeah,
Great. Thanks. How about you, Jen?
Yeah, I just put all the sites in there. So
Ah.
jenmaldonado.com. You can find me on Instagram with Invest with Jen Maldonado. I have a YouTube channel too where we talk about different things. Invest with Jen. We're in cashherspark.org. And there I also have a really good due diligence checklist for people who wants to invest in syndications, Mike.
Awesome. Thanks, Jen. Appreciate everybody being here. If anybody wants to reach out to me, you can reach me through Instagram is probably the easiest place to send me a message, or on LinkedIn. So I look forward to talking to anybody who has any questions that we can help with. Again, thanks you guys for being here tonight. I appreciate your time and your knowledge. Good night, everybody.
Good night.
good night. Thank you.